Thank you everyone for signing up and attending today with us, our presentation on Roth conversions and the associated strategies that go along with them. My name is Alex Perney. I will be your presenter today. Too far. All my contact information is right up on the screen in front of you. If you have any questions at the end of this or want a little bit more clarification, feel free to email me or call me separately. But I do want everyone to understand that your audio has been muted on your end, so please do make sure that you type in any questions that you have to the chat box, as they will not be able to hear you through the audio on here. So without any further ado on that front, a few things I'd like everyone to take away from this presentation today are: what accounts can you self-direct, Roth or not? That's an important thing that I need to make sure everyone understands that comes to our presentations. The functions and the purpose of Roth conversions. So there's many different ways to look at these with regards to your tax planning strategies, your investment strategies, and ultimately your retirement strategies in their totality with regards to how tax-exempt investing can work into that, and the strategies associated with the actual Roth conversion. So how they work and their purpose, the strategy of them, and what accounts you can actually do this with is the main purpose of what I would like everyone to take away from today. A little bit about who we are. We've been in business for over 20 plus years. We locate primarily out of our Atlanta and our Tampa markets. We do all of our corporate headquarter work out of our office in Largo in the Tampa Bay area. We have many clients with a very diverse portfolio of different types of non-traditional investments. I think the figure on there is a little bit off, but currently we maintain roughly $800 million worth of assets for our clients. And we have a great network of attorneys and advisors that can help you out with the different strategies that you might come up with in today's presentation. So don't hesitate to give us a question that you think we may or may not be able to answer. If we can't, we're not afraid to tell you that we can't or don't know how to answer it, and we have a good network of referrals for people who can help you out with those more technical questions that you might need some clarification on. And again, we do operate out of Florida and Georgia, but we can operate nation and worldwide with regard to anything that you want to do. If you have a cell phone and access to a printer and scanner, we can pretty much get anything that you want to taken care of. So the history of the IRA, and especially the Roth IRA, it's important to understand where these types of things come from so that you can understand the basis for how long they've been around, the different types of regulatory changes that these things have survived, and their ability to essentially weather the storm of many different types of legislative, administrative changes that go on along with our government and the regulatory bodies that actually affect things that go into these types of accounts and the ultimate good benefits that you do get from these. So the original IRA was written into existence back in the 70s. So in 1974, the original Income Employee Retirement Income Security Act of 1974 was passed, which essentially establishes the individual IRA and a lot more regulation with regard to large pooled pensions and 401ks. So from 1975 till 1997, that's what we had. Now, that is completely just based on deductible contributions into a retirement plan, meaning that I take a portion of my earned income, put it into a plan, get a deduction for that contribution, so long as that I have certain income limits, and then it grows tax deferred. I don't pay any taxes throughout the life cycle of that account, and that's what we were essentially given from 74 or 78 to 97. In 1997, we have legislation passed of the Taxpayer Relief Act of 97, which brings into existence the Roth IRA, 1998 being the first year that you could actually have one open. This opens up the door for the actual IRA to be established, so we are now just about to celebrate its 20th year of being in existence. So pretty cool to think about that. It's not something that's been around for a terribly long time, but it's been through now in its fourth administration, or fourth different administration for the United States government. So it has staying power to actually be a viable type of investment vehicle throughout many different types of regulatory changes that have come about with regard to taxation and different types of retirement planning, especially with regards to tax-favored or tax-sheltered accounts like we see with the IRA and the Roth. Another interesting historical fact on this is that the 401k, as some of you might know, also has a Roth function, but that one's even younger at just around 16 to 17 years old, because that legislation was passed in 2001 to create the Roth feature of a 401k. Again, that's really kind of an interesting function, is that the Roth singular IRA is not the only place that you can get tax-exempt and non-deductible basis investing. You can also get it within a 401k. What I would encourage people to do is that not all 401ks that are offered to you as the participant are created equal in a sense. You do have to check with your administrator and your employer to see if they do offer a 401k Roth function. And if they do, you can certainly utilize that to be of benefit to you with regards to your tax planning strategies for your retirement accounts. So what exactly is a Roth IRA? It's important to understand where they come from, but what is it? So a Roth IRA is a type of personal retirement account. You can't have a marital Roth IRA. There's no such thing as a joint Roth IRA. Every single IRA is opened up in the name of a singular individual. And it allows for non-deductible personal contributions of the taxpayer's income into that plan. So that means, unlike in the traditional IRA, where you put in $1,000 and you get a $1,000 taxable deduction on your income taxes, with this, you essentially are already paying taxes on the way in, which sets you up for the benefit of not having to pay taxes on the way out of that account. Now, the primary benefit of the Roth IRA is that when you distribute the money, you pay no taxes. But understand the life cycle of the majority of different types of retirement plans are going to be very similar, if not exactly the same. So the contribution differences are the main locus for where you will see a difference, whether it be a deductible or non-deductible contribution, and the distribution, whether it is taxable or not, are where the differences lie. The exemption from taxes, such as ordinary income, short or long-term capital gains, Medicare surcharge taxes, all of those types of taxes that are typically levied during the investment life cycle, if you were to be doing things personally or corporately, are going to be assessed the exact same across any type of retirement account. Roth, traditional, SEP, simple, 401k, all of them have the same treatment with regards to those type of taxes for their actual investments. So it's a good point to know that the beginning and end is where you're going to see the primary differences between Roth and traditional type of accounts. Now, how do you get money into a Roth IRA? The actual focus today with regards to the strategies portion will be on the Roth conversion. However, if you are curious to know how to move money directly from an existing IRA to an existing IRA, whether it be a Roth or traditional or a 401k specifically, you do need to know some specific terminology, because these are completely interchangeable from the actual term of Roth conversion. There's the custodial transfer, which is utilized when there are two of the same type of IRAs. So if you have two Roth IRAs, you can do a custodial transfer between them, which there are no taxes and no penalties associated with. Now, with regards to Roth IRAs to Roth IRAs, it's the exact same consideration, but do understand that if you are talking about doing a Roth conversion, simply saying to your administrator or custodian, hey, I'd like to do a transfer between the two, essentially is not conveying the correct message. And also utilizing the term of rollover wouldn't be the correct message either, because transfer and rollover in these constructs don't denote any taxable liability, and a Roth conversion is certainly a taxable event. So understanding the differences between these two, albeit kind of a semantic in some people's eyes, is very important for understanding exactly what you're doing and building a good basis of knowledge to help you correctly invest the money. Now, a direct rollover is a type of distribution, but it is not taxable. The rollover is kind of the universally used term for moving money from one account to another that's not paying taxes, or just in general between retirement accounts. Specifically is that you have to use it when moving from a retirement plan that is offered by an employer, such as a 401k, governmental 457, nonprofit 403b, or a thrift savings plan. You do have to use the direct rollover method in order to move funds from that type of plan into an IRA. Now, you can utilize the direct rollover to move money from the Roth 401k to a Roth IRA, That is a correct utilization of that terminology. But anytime you're talking about specifically doing a conversion, it is simply just going to be with regards to a conversion, not a transfer, not a roll. Okay. And do please remember, ask questions. We haven't gotten into too many of the nuts and bolts yet, but please do make sure that you are asking questions, because that will essentially help to maybe get other people's questions answered as well. You do have to type those in. I see someone just raise their hand. Please type it into the chat box, as all of the audio has been muted. So type it in and we will address those questions. So the types of plans you can self-direct. With regard to specifically tax-free distribution investing, there's essentially 3 different accounts up here that have that functionality. However, the fully tax-exempt investing for just retirement purposes that does not have a restriction on what the expense is related to, there are only 2. Those 2, which have the true Roth functionality, are the Roth IRA and then the individual 401k. Everything else up here, with the exception of the health savings plan, is going to be a deductible contribution and taxable distribution type plan. The traditional IRA, you get a deduction for adding money into it and take the taxes out when it comes back to you in retirement. SEP and simple IRAs, although they are types of qualified employer type plans, they don't have the carve out to have the Roth kicker as the individual 401k plan does. The simple and the SEP IRA both are functions that are going to allow you to contribute much higher amounts to an account than you would to be able to with a traditional or Roth IRA. The SEP IRA maxing out on a contribution basis of $54,000 on a calculation of $270,000 for the individual, and the simple IRA having a little bit more calculations that have to be done insofar as that you actually have an employer contribution and an employee contribution going into that plan. All right. We have a question. Can I convert an inherited IRA into a self-directed IRA? And if so, how does this change things? The inherited IRA requires minimum distributions every year. This is a really good question, and it does kind of illustrate some of the terms that can kind of get people into trouble. You can certainly transfer an inherited IRA, meaning just move it from one platform administrator to another, to self-direct. There's no restriction on what type of account that we can administer here, whether it be an inherited traditional Roth types of IRAs. You can certainly self-direct an inherited IRA. However, unless that an inherited IRA was inherently already a Roth IRA when you inherited it, you cannot do a conversion of that account to a Roth inherited IRA. It doesn't necessarily change anything when you just move administrators. You can just move from, let's say, someone like Fidelity to Advanta with the inherited IRA to do self-directed investing, and there are going to be required minimum distributions every year. You would just indicate to us as the new administrator that you would like to take those and what method you would like to take those, and we can build the distribution and reporting requirements of the inherited IRA for you. But it doesn't essentially necessarily change anything from the perspective of you as the account holder of moving the administrator of it. Okay, Alan asked a good question regarding the 5-year waiting period. So it does not. Now, we're going to get into it a little bit longer, but the 5-year waiting period starts from the time that you initially open the account, and so long as that you maintained that contiguous life cycle of that account, even if you have transferred that account to several different administrators, you're ultimately responsible for tracking that basis of time. But so long as that you have not completely ended the account, distributed, and closed out that, essentially that life cycle of that account, even if it's been moving around, it is still one continuous timeline. So if you've moved an administrator every single year, you don't start that clock over every single year. But ultimately, it would be your responsibility as the account holder to track the basis of that clock to make sure that you have satisfied the 5-year period. Essentially, if you were to ever be audited and they were to ask to make sure that a Roth distribution was not a taxable distribution, you would need to be able to show that the account was transferred and never ended for a continuous 5-year period in that instance. Good question. Now, getting into the last portion of this, the individual 401k, some people might be familiar with it in the fact that you can actually contribute considerably more than most other plans up there. As I mentioned, the SEP IRA does have a high contribution limit, but that is all going to be deductible contributions of that $54,000. Now, the individual 401k is especially attractive for the Roth investors because it gives you the ability for your elective deferral, meaning what you put in out of your own personal paycheck every year, to be made completely without a deduction. So you have the ability to add in up to $18,000 a year if you're covered by a 401k plan as an elective deferral of your compensation. If the company that you work for allows for Roth contributions, you can make an $18,000 Roth contribution into that 401k a year. And if you're over the age of 50 and a half, you can make a $24,000 Roth contribution into that plan a year, which really starts to make those plans extremely attractive, especially for the individuals that qualify for a solo individual 401k. Now, the other portion of that, the actual profit sharing match of the $35,000 or 20% of net operating income, that has to be made deductible into the plan. But you as the participant, if it is 100% vested to you, have the ability to do a Roth conversion of that as well. So you do have quite the ability to make very high amounts of Roth monies available to you in a 401k specifically. Now we're going to put this slide up here right now so people can look at it because we have a few questions. So this basically enumerates and goes over all of the current modified contribution limits for each one of those types of plans. Okay, another question about inherited IRAs. When an inherited IRA is transferred to a self-directed IRA, and if the self-directed IRA earns income, does this have an effect on the minimum amount to withdraw every year, or does the minimum draw remain the same as if it were not transferred? Okay, so it does have some effect on the required minimum distribution. It essentially will increase it slightly, but depending on how much actual income you have is going to kind of determine how much that goes up. So if you do, make very solid groups of investments and then actually have the ability to, greatly increase the value of that, you will increase the amount of money that has to be taken out of it. The calculations for the required minimum distribution of an inherited IRA are going to be based on the, excuse me, the age at which the decedent passed, and their life expectancy tables are factored into that. Also, the age that you are presently, because you have a life expectancy table that has to be put into that calculation, and the fair market value as of December 31st of the previous year is going to give you the essential required minimum distribution of that account that you need to take out on an annual basis. Now, one thing that I do tell people is that if you do have a required minimum distribution, and let's say you're not necessarily doing too much with it and you have earned income, you could potentially use that as the catalyst for contributing money into a Roth IRA. Account for that money, the additional income, into your pool of income every year, and maybe segregate the monies that are coming in to be able to put some more into a Roth IRA. Obviously, if you do fully broken down accounting, the money has to actually come from your earned income, but you can kind of see where you can net out the ability to further contribute to a Roth IRA if you are being forced to take distributions out of a inherited IRA. So again, this slide does illustrate pretty nicely the limitations that you are going to be looking at with regards to how much money you can get into a Roth IRA on an annual basis. So that kind of brings up the question, well, what's the big attractant to this? Because most of the time your traditional IRA is going to be fully funded by a sizable rollover from deductible contributions to a employer plan for many years. Where does the rest of the money come from? Well, that's where the Roth conversion strategies really come into play, is that it allows you to take the monies from your deductible basis plans, pay the taxes on it, and move it into a Roth IRA. And we're going to get into the actual strategies here in a minute, but this really is kind of an interesting illustration as to show the the small amounts that you can actually put in on an annual basis, and how the Roth conversion can be a very powerful tool to get extra monies in there. Okay, Marcus asks, can I use outside funds to convert a traditional self-directed IRA to a self-directed Roth? There's a couple different questions in there. What I would say is that, can I use outside funds as in personal funds when converting a self-directed IRA, just converting a traditional to a Roth? No, I believe in the instance of that question, it has to be in the actual traditional IRA in order to convert it into a Roth. You couldn't necessarily say, hey, I have an IRA with $10,000 in it, and I'm going to convert $50,000 of personal funds in there with it. If so long as that the monies are in a 401k, IRA, or other type of qualified plan, you can certainly use those monies to consolidate and do a Roth conversion, but you cannot necessarily just take money out of like a personal money market or a personal brokerage account and then put it. Can you pay the, oh, okay, I see what you're asking. The question was actually more structured on where you pay the taxes, I believe. The taxes for a Roth conversion are paid outside of the IRA. So anytime that you do a conversion of any given amount, the liability that you receive that you need to pay is personal. So when you go to file your taxes on an annual basis, you file the Form 1099-R as an addendum to your 1040, and then when you do your calculations, that's going to determine how much of a taxable liability you have to pay. So just like you would essentially maybe have a taxable liability at the end of the year or a refund, the actual deductions, credits, and everything else help chip away at how much you're actually liable for at the end of the year. So the taxes aren't necessarily paid as like a mandatory withholding when you do a Roth conversion. You wait till the end of the year when you file your or the beginning of the next year when you file your taxes, and then determine how much money you actually have to pay, or if you have to pay anything out of pocket at all if there's no net washout from deductions and credits that might help effectively keep you from having to pay out of pocket for that. So again, the Roth conversions, the liability for the funds converted are paid personally, not out of the funds that you are converting, which is a good question because that would certainly limit the amount of money that one could potentially get into a Roth IRA if you were not only having to pay taxes, but having to pay the taxes out of those funds as well. Now, with regards to Roth IRAs specifically, a lot of people think that you have to have a Roth IRA to do a certain type of investing. Some people might say, hey, to do real estate in an IRA or to do, an LLC or certain types of trading, you have to have a Roth IRA to do it. And it's simply not true. You can do any type of investing through any different type of account. There are no restrictions on the allowable investments across any of the different types of accounts. Now, there are certain restrictions that you do have to follow, namely being that you do have to make sure that you are not dealing with a disqualified individual, meaning that your IRA, whether it's a Roth, SEP, traditional, or 401k, cannot directly purchase, sell, or deal with in a transactional manager your mother, father, son, daughter, or yourself personally. Okay, Gary asked a question. Does the amount of funds converted from a traditional to a Roth IRA count towards your taxable income that is used to calculate your benefits and the cost of Medicare? So when you're doing your calculations, the Roth IRA conversion simply goes into your modified adjusted gross income for the given year. So your modified adjusted gross, which goes against all of your credits and your deductions, is where you're going to file that. Now, I am no expert, and in all honesty, as much information as I do have, I just, in all honesty, do not know where your Medicare liabilities or benefits are calculated off of, if that's modified adjusted gross or if that's a net gross number. So Gary, I would honestly have to point you to a CPA for that question. I honestly don't know. Okay, so moving on, we do have the ability to invest in many different things, but there are certain people you can't deal with, be it your mother, father, son, daughter, or yourself personally. So all of these, doesn't matter if it's a Roth or any type of other account, can invest exactly the same. But understand that the restrictions are going to be levied on who you can't deal with, and there's very few things that you cannot invest in, be it life insurance or anything that derives its value from collectability. Life insurance is always going to typically be paid out in a term or total coverage as a tax-exempt payout anyway, so there's really no need to have it in a Roth IRA or any other type of qualified plan. And then anything that derives its value from collectability. So rare bottles of wine, antiques, artwork, stamps, certain types of coins you can't invest in with an IRA, whether that's a Roth, SEP, traditional 401k. These are the restrictions of what you cannot invest in and whom you cannot invest with. So again, the IRA, your spouse, any direct lineal descendants or ascendants are the individuals that you cannot invest with. Okay, thanks for the clarification, Gary. It is modified gross, but huge penalties increase premiums for individuals and married over different modified adjusted gross incomes. So then, yeah, I mean, if it's going, the 1099 that you get is going to adjust your modified adjusted gross on a given year, and then it also, if you are filing jointly, it will affect that total number. So it's not going to be any type of separate accounting that each individual has to pay separately from their filing status. If you are filing jointly, you pay it jointly. If you're filing it singly, you pay it singly. And if you're married filing individually, then you would pay that liability singly. So then it would just be calculated on those same numbers, per what you've given us. So good question, Gary. So there's certainly some considerations because there wouldn't be options out there if there weren't different reasonings for different people wanting different types of accounts. Now, it may seem inherently very attractive to have completely tax-exempt distributions out of a qualified retirement account. I know I certainly would like it if not a single one of my paychecks didn't have taxes taken out of it. But the ability to walk down that road and get to the ultimate end goal of having tax-free distributions from a retirement account, there are things that you have to give up, and there are certain rubs, if you will, that you have to go through in order to get it done correctly. So the tax-free earnings are great because you get to exempt yourself from all the earnings, but you have to go through a few different you have to jump through a few different hoops in order to get to the correct end goal. Now, there's no taxation on the withdrawals, but you do have to have either paid taxes as a lump sum on a conversion. You have either had to have made non-deductible contributions for many years in order to get there, or I should say, and you have to give up the ability to have had deductible contributions throughout all of these years. So depending on what your tax bracket might have been, you could have not only been paying taxes on that income, but also losing out on potential deductions that could have helped maybe bring you down into a different tax bracket, helping you pay lower taxes at that time anyway. One big benefit is that there is no required minimum distribution. The kind of basis of thought behind this is that you have already paid taxes on the way in to a Roth IRA. So the reasoning for having a required minimum distribution insofar as that the IRS has never seen any revenue from a traditional IRA goes away. So you actually don't have to have a required minimum distribution at the age of 70 and a half. So you also get to take advantage of the lower potentially present taxable rates. If you look at a historical curve, you typically will always see one thing trending, and that is the increase, and that is how much taxes you are paying increasing over time. Granted, there might be certain personal aspects of your income that help you to reduce it on a year-over-year basis, and other types of things, but you will typically just see it as a trending upward slope for taxes. So if you are going to try to go along a historical curve, then you could potentially utilize the lower tax rates now and then be paying no taxes later, as opposed to getting deductions now and then paying taxes, albeit incrementally smaller portions later than you would now. Jeannie asked an interesting question. One of the items listed as not allowable is coins. Does this include Bitcoin and digital cryptocurrencies? And can I invest in Bitcoin in a self-directed IRA? Funny you'd ask that. I actually just did a really comprehensive presentation and webinar 2 Fridays ago on Bitcoin. The answer is yes, you can invest in cryptocurrencies with an IRA. Specifically, what I was referring to in the previous slide is that you cannot invest in coins. Things like rare American Eagles are things that are traded on their collectible value rather than their bullion content. The coins specifically that you can invest in with an IRA, more to the kind of tangible aspect of the previous slide, is referring to coins that are traded on their bullion content. So things like newly minted American Eagles, silver American Eagles, platinum buffaloes, things like that that are traded just for the, precious metal content are allowable in an IRA. But digital cryptocurrencies is a fascinating topic. Like I said, I have done hour-long presentations and done many different things on that, so I'm not going to burn up too much time today with that, but certainly give me a call. I can kind of run through it, or go to our website, advantaira.com, to our Learning Center tab, and that presentation I gave 2 weeks ago is actually hosted on there, so you can go through and listen to it and get some good information for it. But thanks for the question. So another good consideration for a Roth IRA is that with the workforce continuing to age and work longer within the United States, that you have the ability, when you have a Roth IRA, to continue to contribute if you are still making ordinary income after the age of 70 and a half. When you reach the age of 70 and a half, a few things happen. If you have a traditional IRA, you have to start taking required minimum distributions, meaning that you have to take a certain amount of money out every year, which is calculated on your filing status of either being married or single, your life expectancy, and the total value of the account. Now, those things go into a calculation that spits out a number saying, hey, I have to take this much out of the IRA a year. And it is kind of a burden, especially if you are invested in illiquid assets. Let's say you're invested in a piece of real estate that doesn't necessarily have too much appreciable income to cover something like that, or if you are invested in something like a balloon promissory note that doesn't have any income for several years. How do you go about handling that? Well, if it's in a Roth IRA, you don't have to worry about that, and you also don't have to worry about paying taxes when it pays off and you take a distribution when you're of that age anyway. One thing I'll tell you is that do not ignore required minimum distribution requirements. They are extremely important, and the penalty for not taking a required minimum distribution out of a qualified retirement plan is 50% of the distributable amount that has to be paid as a penalty, and you still have to pay taxes on the total amount that's distributed. Easy example, if you have a $10,000 required minimum distribution and you fail to take it in a timely manner, you have to pay $5,000 to the IRS as a penalty, and you still have to pay taxes on $10,000. So it is something that they try to make sure that you certainly do take. And if it's something you don't want to take, start utilizing a conversion strategy. Something that I've told clients for a long time is that if you are getting up to that age, think about taking incremental required minimum distributions in order to help, one, reduce the amount of cash and value in your traditional IRA, two, to get money into a tax-exempt distribution plan, and then three, then you also have the ability to have either exempted yourself from even having a traditional IRA and just having the Roth IRA, or have reduced it to the point where even if you do have an illiquid asset in that account, that you're not worried about running into the ability of not being able to take the distribution. All right, got some good questions. Okay, got it. One about fair market values. My assets are in limited partner interests in real estate partnerships. Who was responsible for valuing the LP interest at the time of their being converted to a Roth IRA? That's a good question. Essentially, we would need a qualified third party to value the LP interest if you're doing a Roth conversion. It is kind of a little bit harder for me to tell you if essentially that limited partnership holds real estate. A property appraiser really isn't who you go to for that. You would probably need to contact a qualifying accountant, or maybe someone that does partnership valuations, someone that can give a certified valuation of that limited partnership interest, and you would need to be the one that vets and brings that qualified person to levying that valuation for your IRA. Let's see. Ed asks, can you use the RMD to pay for the conversion from a traditional to a Roth? Kind of. It's a good question. So you take money out as a required minimum distribution. Then you do a conversion. And let's say the taxable liability on the conversion of what you move from that traditional to the Roth is the exact same amount as your required minimum distribution that you took out. You could stroke that right back over to the IRS and use it to pay for it. So that's certainly something you could do. But you would have to take the required minimum distribution out and pay taxes on it, and then do the conversion separately. I actually looked into that a few years ago with a client. Is a Roth conversion, even though you are paying taxes on it, does not reduce or mitigate a required minimum distribution liability. It's actually clearly enumerated in there. So as much as I was hoping for my client that that was a ability for him to just do a conversion and just move the money over and not have to take RMD, unfortunately, it's not the case. Dave, is the conversion cost from traditional to Roth only your marginal tax rate or a 10% penalty? No, it is just your marginal tax rate. So whatever your tax rate is after your, it's your modified as it grows. So that's the only thing that it affects into it. You're not due a 10% early withdrawal excise tax penalty for doing a Roth conversion before the age of 59 and a half. Great questions. Keep them coming. These certainly are certainly enriching questions. But back to the presentation a little bit. I'll file a few off once we get a few more in. Roth IRA distributions. Now, in order to get the full benefit of a fully tax-free distribution, there's a few things that you have to consider. It's not as easy as just being 59 and a half and getting rid of the 10% early withdrawal penalty. There's a few more things that you have to look at with regard to a Roth IRA distribution. There's some really cool things, but then there's some things that aren't exactly the most fun things to have to deal with. So to get a fully tax-free distribution of earnings, now, an IRA, a Roth IRA, a really cool part of that is that any of your contributions over the years are considered basis that you can distribute tax and penalty free at any time. And those are the first things that are distributed out of those accounts. So the earnings are primarily what we're going to focus on when we talk about the fully tax-free distribution, because anyone can always access their Roth IRA contributions anytime tax and penalty free. So think about it kind of like a little savings account, a little rainy day account in that IRA that you can always touch is going to be your contributions. So the IRA holder must be 59 and a half to get fully qualified distributions of their earnings. Contributions can be distributed at any time, tax and penalty free. The tax paid on converted amounts is assessed at ordinary income rates, and all contributions have to be made from earned income. So the income that you make is only the thing that you can use to do a contribution. A conversion, however, that monies can come from any different type of qualified retirement plan that is directly portable to a traditional IRA. So what does that mean? So if you have a Roth, if you have a 401k, a governmental 457, a thrift savings plan, or any type of employer-based plan that you can move to a traditional IRA without any tax or penalty, and that's the thing to remember, is that if you can look at any plan, if you can move it to a traditional IRA, you can convert that to a Roth IRA, and you're not going to be paying any 10% penalty for early withdrawal. It's just going to be paid at your ordinary taxable rate. Now, with Roth IRAs, there's also some special considerations for what is distributed when. There's layers kind of like a cake when it comes to distributing money out of a Roth IRA. You first distribute your contributions. So the $5,500 or $6,500 a year that you've been adding into for X number of years, that is going to be distributed first. The next layer that you hit is your converted amounts are distributed second. Now those converted amounts, yes, you've already paid taxes on them, but in order to distribute them fully tax-free, the conversions have to have aged for at least 5 years. Now, if you ever did want to move them back, you could do a recharacterization, but the converted amounts also do have to age for 5 years, and the earnings attributable to any of those have to age for at least 5 years as well in order to be distributed tax-free. Now, a lot of people are understanding that there are phase-outs for having a Roth IRA, meaning that, oh, I make too much money, I can't have a Roth IRA. Well, you can't just inherently take a check and stroke it into your Roth IRA. if you make too much money. That is correct. But anyone can have a Roth IRA. Let's say you started from a lower taxable income rate and you are now making considerable amounts of money. You don't have to get rid of your Roth IRA. Conversely, if you have a traditional IRA and you are not getting a deduction for it, it might also be a really good time to look at getting and contributing to a Roth IRA. So if you're already not taking a deduction because you're covered by an employer-sponsored plan, then why not make it into a Roth IRA? So here's what you need to look at. The ability to add money in directly out of your pocket of your earned income into an account is a phase-out limitation, meaning that when you get to a certain income range, your ability to do so directly will be affected. So for a single individual, meaning that you file your taxes as an individual, if you are making $118,000, you can still make a full contribution. If you are making $133,000, you cannot make a contribution, and the dollar figures between those two is the phase-out period, meaning that you progressively between those two figures will be able to add in less and less and less. Now, if you're filing jointly, the bottom end starts at $186,000 and goes up to $196,000. So again, bottom end, you can still do it. Top end, unfortunately, you can't add money directly in. And if you are separately filing and as a married couple, the limitation is $10,000. Also keep in mind that these are closely pegged on the phase-out limitations for deductibility of contributions into a traditional IRA if you are covered by an employer-sponsored plan, meaning that if you make along these same figures and you are adding money into a traditional IRA on an annual basis and covered by a employer-sponsored plan like a 401k, you would not be able to take a deduction for those going along these same limits of phase-outs. That is modified adjusted for a single filer. Right. All right. Now, a lot of people ask and are kind of curious to know, well, if the Roth IRA is so great and you're not paying any taxes on the way out, let's say you've tripled, quadrupled, 10 times the amount of money in value that you put in and the IRS is not getting any money from it during that time, then why essentially is it going to be allowed? And what's out there to make you think that it's going to be something that has longevity to stick around? Why would I put my time and money, literally my money, into it if it's not going to be something that's going to be down the road? And this is just my personal conjecture of what I see with this. This isn't anything that's inherently, cast or verifiable fact. It is certainly my opinion, but it is an interesting way to look at it. And it kind of goes along the same adage as is a bird in the hand worth two in the bush, in that the IRS essentially is getting more upfront taxable revenue from a Roth IRA than it ever will with a traditional IRA. So if you have 100 individuals who make $5,000 contributions to a traditional IRA, that is $500,000 worth of tax deductions that the IRS has to file on their books. If the taxpayer average tax rate is 20%, this results in $100,000 less in tax revenue that they don't get. Multiply this by the actual number of people doing it, and you'll kind of get a more accurate figure. But the number of the amount of taxes is significantly less, and couple that with the fact that people are living longer, working longer, the ability for them to actually get money out of these accounts or actually realize any revenue is going to be significantly pushed farther out into the future, so that they're essentially carrying these potential future earnings way on down the road. As opposed to with a Roth IRA, you have the same 100 individuals make $5,000 contributions to their Roth IRAs. Without those deductions, that $100,000 in lost taxable revenue at 20% marginal tax rate is going to be realized currently on the books by the IRS. They're actually going to get paid that money presently, and they're not going to have to carry forward any type of potential taxable revenue calculations for them. So they're actually making more money in the present than they are with a traditional IRA. Now, would this make sense if no one had the ability to have a traditional IRA? No, but it is a good give and take where they are guaranteeing themselves more current revenue, losing out on some future revenue, but also having the ability to have the future revenue come in by virtue of the fact of the required minimum distribution down the road. So the actual definition for this is that you are taking the pre-tax dollars in one account and moving it into a new tax-exempt account. So you are paying taxes now, and then going forward in the future, you are not paying any taxes going into that. Now, looking at this from the perspective of where exactly the conversion comes from, there are some other historical factors that go into it. Some people may remember back prior to 2001, if you had a modified adjusted gross income of $100,000 or more, you could not do a Roth conversion. And you also could not file separately for that as well. You had to be filing jointly if you were married, or obviously single if you're single, in order to do a Roth conversion. So some of the special considerations that you need to look at, a lot of things that you do with regards to tax planning and different strategies. You have Ooh, Alan, that's a really good question. I'll get to that in 1 second. You do have until April 15th in order to maybe unwind something or otherwise file something. You have until the 15th to make a previous year contribution to an IRA. So what about Roth conversions? Roth conversions are kind of one of the special exceptions, is that you have to make that in the actual year that you perform the conversion. You have to do it between January 1 and December 31 to count it in that taxable year. It's included in your personal taxable income. And remember, losses personally have the potential to offset some of the income realized from a conversion. And you can unwind a conversion. So going back to the question regarding legislative changes, if it does change from year to year and you want to maybe unwind a contribution, you have the ability to do a recharacterization, but you do have to recharacterize any earnings, and you might have to pay taxes on it as well. Oh yeah, Mark, just if you were kicked off, the period starts from the date that you established that account. So if you had an employer's plan for many years and then you started a new Roth IRA, did a conversion, that 5-year holding period starts from the year in which you established that account. Okay, so Alan, great question. Can you pay your taxes due on the Roth conversion over a 2-year period? You do kind of have a strategy to do that. So, and what I mean by that is that here's one example of how I've seen that done. I had a client that wanted to convert a piece of real estate in his IRA into a Roth IRA. He didn't want to take the full, and it was, let's just call it $80,000 as a taxable liability that year. So what we did is we had him do a appraisal of the property in the middle of December. We did the Roth conversion the last week of December before we left for the New Year's holiday. Then the second we got back from the New Year's holiday, we converted the other portion of it. So we managed to convert over 2 different years a singular amount of one property, and then he was able to split that liability between 2 years. So instead of actually doing the full $80,000 in 1 year, he essentially accomplished the full Roth conversion of the piece of property within 2 weeks, but managed to split the liability across 2 taxable years. So you don't necessarily have the ability to just do a conversion and then do a carry forward or some other type of tax planning strategy with it. You are liable for the taxable liability in the year in which you performed it, but depending on what you're actually trying to convert, whether it's an in-kind asset or whether it's just a cash conversion, you do have some different strategies in order to mitigate that taxable liability over more than 1 year. So there is some differences between the type of conversions that you're doing. You can do conversions. You can do conversions of either assets or cash. You don't necessarily have to sell an asset in an IRA in order to convert it. You can convert a piece of real estate. You can convert a note. You can convert stock if you don't want to sell it and then have to rebuy it. You can do a lot of different things with this that don't just involve selling and converting cash. Obviously, cash is going to be a pretty easy thing to do. It's converted at it's converted dollar for dollar in value. So if I convert $10, I pay I have an additional $10 that goes onto my adjusted gross income at the end of the year. And unless other circumstances exist, you can do this conversion without any type of special documentation. You just need to contact your custodian and administrator and then have them perform the applicable movement in their books and then properly report that to the IRS. In-kind distributions of assets are a little bit more involved. So you have to have a certified appraisal of the asset that you're going to be converting. There may need to be some re-registrations done, especially if this is a piece of stock or if it is a piece of real estate that needs to have a new deed drafted, if there's an amendment to a promissory note or a re-registration of a private stock certificate. So there is a little bit more involved in doing a conversion of a tangible asset, but it can be done. And then clear all records of the activity within the IRA as well. So that's what we need to have is clear records of exactly what's happening with that being able to be shown within the IRA secondarily. Okay, got a couple more questions. Does the tax-free growth start at the conversion date or at the end of the tax year? I think I know what you're getting at. So, Marcus, the tax-free growth essentially is the entire life cycle of the account. If I convert something, I've paid the taxes in that taxable year. So if I convert $100,000 and I grow it to $200,000 by the end of the year, it's all going to grow tax exempt. You're not paying any taxes during that life cycle. You also wouldn't be paying any taxes during that life cycle in a traditional IRA. So keep in mind that the tax exemption for a Roth IRA comes at the very end when you take a distribution. The growth of the account throughout its life cycle is always going to be tax-free no matter what type of account it is.